This is very exciting to have the opportunity to chat with everyone today. I'd love to make this as interactive as possible, so please send your questions in. We want to keep this really interactive. I'll also be sharing some Bloomberg screens as we kind of talk through this environment, so we can have a little bit more context about what's going on. As you saw from the title of this live stream presentation, we want to talk a little bit about consensus and kind of where consensus is specifically for the inflation markets, because the one thing, everyone I think that I talk to, all the institutional investors, financial advisors, RIAs, endowments, foundations, pensions, pretty much every type of investor across the board is in the camp that we have passed peak inflation. And so I'm not trying to disagree whether we passed peak inflation or not. This is not some, pontification about the macro environment, but I do want to show people about what's priced into future inflation expectations. And, you can be your own judge about whether you think that's accurate or not, but inflation markets, like all markets, move off of expectations in the future. So it's not what was the last, inflation print data, what happened in the past. It's all about expectations in the future. So that's kind of my focus today. Really, this is all about education, and this is really for you guys to help you get a glimpse. The inflation protected markets are pretty new in the rates space. A lot of people these days are looking at what happened in the 1970s during the last period of inflation. And I always try to remind investors that even the Treasury inflation protected securities market, so those are TIPS, they're abbreviated Treasury inflation protected securities, that's the inflation protected bond market. That didn't even start until 1997. That's when the US Treasury issued the first inflation protected bonds. So when people look at what happened in the 70s or what happened in the last period of stagflation, inflation outside of today, a lot of people look at equities, commodities, real estate, things that existed back during that time period. So I think it's really important to recognize that the inflation derivative markets, even the swaps market didn't really start until the late 80s. And so there's not a lot to look at in the last period outside of commodities and equities and gold and oil. And I think that's why so many people look at that. So today, this conversation, I really want to focus on the inflation protected bond markets, on the rates market specifically, and talk about what's priced in. Let me pause there just to see, make sure we're not having any technical issues anymore. Everyone can hear me. And obviously, if you have any questions, just send them in as we go, because I want to keep it really, really interactive. Sounds good? So, all right, so let me start by sharing my Bloomberg screen. I want to bring up, let's see, I'm going to share this screen. I'm going to just start with a basic Bloomberg. All right, hopefully you can all see my Bloomberg screen. This is the, what this code is that I have pulled up here is the inflation break even. So let me maybe just start with what this is. This is looking at the inflation protected bond market versus nominal treasuries, which is regular treasury bonds, which is, just regular, it doesn't have any reset with CPI. So let's just take this is the 1 year break even. And I just want to bring up a chart of this because I think it's pretty outstanding when you think about, like, let's just go back and look at a 1 year chart starting at the beginning of 2022. The Fed started, they went from, remember, not even thinking about raising rates to suddenly in the June 21 meeting, having the dot plot show 2 hikes, just to put it in context. So it was only June 2020 one, when the Fed went from not even thinking about raising rates to being like, oh gosh, inflation's a problem. They actually started hiking rates. Now the market moved ahead of actual hikes because the market started pricing in the rate hikes. But the first set of Fed hikes was actually in March 22. So remember, we had in March 22, we had the Fed hike 425 basis points between March and December. And this is a thing that I think is really amazing, that after the Fed's first rate hike, inflation expectations as measured by CPI in the inflation protected bond market started to fall, and it started to fall dramatically. And I wanted to pull this up because you can see back before, like right around when the Fed did their first rate hike, CPI inflation. So this is the one problem with tips by themselves is tips only reset with the consumer price index. So I think that's kind of an issue because CPI is just one index, right? And the Bureau of Labor Statistics calculates this index. And obviously, they do the best that they can, creating this basket of consumer goods. The problem though with just CPI is that it's just one index, and a third of that index is what they called owner occupied rent in the form of shelter. So the shelter component is about a third of CPI, and that's mostly rent. And so I think CPI is a little bit of a, it's a lagging indicator because rents typically are, 1 year or longer. So it's a little bit lagged with the data because it's more backward looking, and B, just such a big component of it is rent. So I do think there are a lot of different ways to think about inflation. Even the Fed doesn't use that one, one index. So that's a one downside with the inflation protected bond markets that are issued by the US Treasury, the TIPS market, is that they only reset with the CPI index. But let's just take for a minute what we got, which is the inflation expectations. And going back to, let me share my Bloomberg screen again so we can continue this discussion. So I'm going to bring up another Bloomberg here. Sorry, more tab, because I want to show you the year over year CPI changes. So let me show you this. So the CPI back in 22 was 8.5%, but when the Fed started hiking interest rates, inflation expectations started to fall. And that's because the market said, aha, the Fed is being hawkish, the Fed is going to tackle inflation, the Fed is getting serious. And so all through 2022, inflation expectations actually fell really dramatically. You can see that this is the 1 year, and I think the 1 year is an important number to look at because we're just talking about the last print was 6.5, and 1 year forward, the market is priced at 216. The very interesting thing about this is that all inflation expectations, even long dated one, here's the, just drag over and add it to a new window. Here's the 10-year break even, and it's very similar. The break even curve is super flat. So across the curve, markets are expecting inflation expectations to just be a touch above 2%. And I think that's a really important number because the consensus in the market is that we've passed peak inflation, and that's being priced into the inflation protected bond markets. So it's fully expected by the market that inflation is going to fall dramatically in the future. And that's what, just like, a lot of people look at the stock market, a company can miss, if they beat earnings, even if they lose money, the stock can trade up. So all markets move off of the expectation in the future. And the same thing does apply in the inflation protected markets. So let me pause there just to check in with the audience. I can't tell, unfortunately, who's streaming on this, but if we have any questions, I'm happy to take a pause and make this really interactive. So let me just give the moderator a chance. Are there any questions that we have so far?
right now we don't have any questions, Nancy, if you want to keep going.
Thank you. Thank you. Just checking in so we can keep it interactive as we get questions. So basically, when the Fed started hiking rates, the market's future inflation expectations started to fall dramatically. And even though the Fed kept hiking all throughout 22, inflation expectations kept falling. And so I think the thing that investors really need to step back and look at is like, look, does, the market is already pricing in CPI is going to be right around 2%. So the Fed does have a tremendous amount of confidence in the market that hiking policy rates is going to ease future inflation expectations. And that I think is something important that investors should be aware about, because, it's all about, what you think is right. And I'm not making a macro call about whether we've passed peak inflation or we haven't. I'm just showing you what's priced in is that we've definitely past peak inflation, because all of the inflation protected bond markets are pricing right around 2% right now. So then I'd love to move to yield curves. So let me just bring up.
Nancy, I just want to interrupt. We did get a question if you would like to answer it.
Oh, sure. Yeah, I'd love to.
Do you expect real estate prices to continue to go down this year?
Oh, that's a good one. I personally do, but I am not a professional real estate investor. My expertise is in the inflation markets and fixed income and financial markets and volatility, not in real estate. So I would say, take it with a grain of salt. Like, I personally think that, the rise in mortgage rates is, it has to have an increase in wage inflation in order for people to afford these payments. And so a lot of times, people look at the real estate market and it's really gone up for, pick a number, like really since the 70s, not consistently. Obviously, we've had the financial crisis and other periods where the real estate market sells off. But I do think you have to correlate real estate with this kind of bond bull market and cheap capital. Now with the Fed hiking, 425 basis points with more hikes, we have another 58 basis points of hikes priced in this first half of 23. So we have more hikes priced in, then we have cuts priced in. So it's kind of confusing because we have first hikes and then cuts, but definitely I do think real estate is very linked to interest rates, and interest rates have gotten higher, which makes the cost of borrowing higher. And you either need a lot of wage inflation or lower property prices to afford the same house payment. So I think it's hard to know. And again, I'm not a real estate professional, but I do think most professional real estate investors hedge their rate exposure, right? Or at least they used to. Not all of them, but a lot of large real estate investors will hedge rates. And before the Fed started embarking on quantitative easing after the financial crisis, most mortgage investors did something called convexity hedging. I don't want to go too far down a rabbit hole, but basically they would buy rate volatility to hedge the implicit short volatility that is embedded in mortgages. If you just take a step back and think about, what is a mortgage, right? US homeowners, now it's not the same in all countries. So like in Canada, you can't prepay your loan, you have a penalty. But in the United States, at least for now, a homeowner chooses when they can prepay their loan. They have the right to pay it off whenever they want. They don't have to get special permission. They don't have to hold it for a term. Basically, if you I don't know, win the lottery and you decide, hey, I want to own my home outright and stop paying the interest to whoever your mortgage lender is, you can do it whenever you want. So very simply, I think about mortgages. If you own a financial mortgage, you're basically short options to US homeowner because they're the ones that have that optionality, and the owner of the financial mortgage is actually short options to homeowners. And so sometimes that's called convexity hedging, but basically mortgage investors, prior to the Fed sort of gobbling up the mortgage market with their QE purchases, they used to hedge their interest rate volatility by buying rate vol. Starting really last year, we've started to see some of that hedging come back now that the Fed has embarked on, not only stopping QE, but kind of slowly, very slowly starting to reduce their balance sheet with the quantitative tightening. And so they're not selling anything yet. They're just letting, as bonds mature, they're keeping the balance sheet level after the caps are met. So they're letting some bonds mature, but it's really tiny if you think about it, because the Fed in the 8 weeks following the depths of the COVID crisis in March 2020, they expanded their balance sheet more in that 8-week period than they did in the previous 9 years of quantitative easing. So the balance sheet just exploded. And they also, remember, they cut rates at emergency, 150 basis point rate cut that they did on Sunday night. Powell did that. So they were easing dramatically and massively expanding their balance sheet. I think the challenge now is that we're in this new era of quantitative tightening, with the Fed allowing, and think about the caps, they're really, really tiny. If you think, the Fed's SOMA holdings, which is the piece of the balance sheet that they actually bought in the open market. So those are the bonds and mortgages that the Fed went out to the market and bought in QE. That's still over $8 trillion. So the caps that we have are really, really small compared to the amount of the balance sheet, the size of it, the absolute magnitude. And so I do think as we have more quantitative tightening, more mortgages in particular allowed to roll off the balance sheet, and also the Fed not being that kind of buyer of last resort, we will see more mortgage investors hedging that negative convexity that's embedded in mortgages. And to hedge that, they go out and buy, it's not equity vol, it's fixed income vol. They buy rate volatility, typically in the swaptions market, because it's unfunded. The swaps, so not to go too much far down a rabbit hole, but there are lots of different US interest rates. There's, now we have SOFR, there's the treasury markets, there's the swap market, which is a lot bigger. Maybe I'll share my screen for a sec, because it's kind of fascinating to me how big the swap market is. Let me share my screen. Can you see this? So I'm the portfolio manager for the IVOL ETF. This is it's a mouthful, the quadratic interest rate volatility and inflation hedge ETF. It trades under IVOL, but if you go, this is just our fact sheet. And I wanted to show the second page of the fact sheet, because it's pretty amazing actually how large the rates market is. And this is what a lot of people don't look at the rates market when they're looking at inflation, because it didn't really exist. The swaps market started in the late 80s. So it didn't exist in the 70s during the last period of very high inflation. But I think this is a very important market to watch. And when going back to the question about real estate, a lot of investors in the mortgage market used to hedge that kind of embedded short volatility in mortgages using this market. Now that the Fed has stopped their QE purchase and allowing quantitative tightening, although it's tiny and not really meaningful yet, I do expect a lot more of these negative convexity hedgers will come back into the rates market and buy rate volatility. We saw that last year with rate volatility moving higher, whereas equity vol was really falling. And I think it's a trend that will, it's hard to say, but if you just take a step back and think about it, the Fed was buying all these bonds in the market. Now they're not buying. We also have a much stronger US dollar relative to the rest of the world, and that's because of the rate differentials, because the Fed was the first large developed market central bank to hike rates. They were ahead of the ECB. The Bank of Japan is still doing, they've widened their band on yield curve control, but they're still doing QE and stimulus, and they haven't changed from that dovish stance. So the dollar appreciated a lot. It had lots of volatility, but essentially our US government debt, we're relying on the Fed as the biggest owner of treasuries in the market, but the close seconds are China and Japan. So I do think it's really important for investors to be thinking about, the cost of financing, especially as we go into the debt ceiling, and with the amount of fiscal stimulus that's really, it depends on the state, but some states are actually sending, inflation relief checks to people in the mail, which is very well-meaning policy, but it could have, I'm worried about kind of the second order impacts to the labor market, because, the labor market is very tight, and, if somebody's getting checks in the mail, would they be as motivated to go get a job? Does it have second order impacts? And so I think it's really important when you're looking at the inflation markets to say, look, the last CPI print was 6.5. Nobody in the market thinks that's going to do anything but fall. And it's priced in the inflation protected bond markets to fall right around, that symmetric 2% really across all curves. And so I think that presents an opportunity for investors to think on their own and think, does the Fed hiking rates, does it really matter with the labor market being so tight and the supply side disruptions and the fiscal spending? It's just kind of one side of the equation that's affecting demand, but it's not really impacting, in my opinion, a lot of the other things that the Fed can't adjust. So let me pause there. Do we have any other questions from the audience, or hopefully that was helpful to talk a little bit about real estate?
We only have a few minutes left. If you want to finish your presentation, and then time permitting at the end, and we can ask some more questions if there's some available.
Yeah, sure. I would love to spend a moment just talking about the US yield curve. A lot of people look at break evens and inflation protected bond markets, but I do think the yield curve and that term premium is a really interesting way to see what consensus is in the rates market. I'm going to just share my Bloomberg screen for another sec to bring up. There are a lot of different yield curves out there. There's a lot of people will look at, different 3-month, 10-year. You can look at the treasury markets. You can look at the swap markets. I'm going to pull up the swap market just because it's such a bigger market than the treasury market. And I want to bring up this chart, share screen. So here is a chart of the current 2s, 10s. So this is the difference between the 2-year and the 10-year interest rate. And I'm going to go to the max data that we can show you, which goes back to the 80s. Just give me 1 second. It's a lot of data, so it's taking a sec for Bloomberg to calculate. Where's my screen stuck? Here we go, max. So this is, why is it? Oh, it's because I have it on quarterly. I'm having trouble going all the way back. So hold on, let me try again. Sorry, my Bloomberg's being a little weird. Let me close it. Oops, no, not close it there. Well, anyway, the yield curve has massively inverted. It's actually inverted more than, hold on, let me stop sharing my screen and try to exit that and open up a new window. It's inverted more than it was even in the 1980s. And I think that's really an important thing for people to be watching, because often the yield curve is, some people say it's a predictor of a recession. Some people say it's a cause of a recession. But here, I finally got, my Bloomberg was a little stuck. So let me just bring it up now. I have it fixed. So this is going back to the history. The swaps market data really starts in the in the late 80s. So here you can see this is around 88. And I'm just going to do a little quick, my Zoom screen is right in the wrong place. I want to show a little line with 0. Hold on 1 second. I'm going to annotate this, and I'm going to draw a line at the 0 bound, just showing you how amazing this is, how inverted the curve is, how much this consensus of recession is being priced into the market. So here is the 2s10 swap curves. This is the difference between the 2-year and the 10-year interest rate. In most normal markets, if you lend people money longer, just to keep it really simple, you expect to get paid more yield, right? More yield to lend longer. Normal yield curve is an upward sloping yield curve. Today is a massively inverted yield curve. It's actually the most inverted yield curve ever in the history of the financial derivative markets. You can see this data goes back to the late 80s, and the periods that the yield curve has inverted was in the late 80s in the swaps market when the data started. We kind of touched 0 right before the financial crisis. And then this is when, in the fall of 2019, it went a little bit below 0. But today's environment is really unprecedented because it's never been this inverted and this low for this long ever in the history of the swaps market data. And so this is a very unusual environment. And I think this is very telling that the US has kind of been the best in the rest of the world, and a lot of investors are owning US long-dated government bonds and US swaps, betting that the Fed hiking rates is going to cause a recession, and that owning duration is a better place to be because the Fed will eventually be cutting rates. And so I think this is really telling because the yield curve's never been this inverted before. And think about this. This is like if you own, let me bring up, just bring up a T-bill, right? These are the T-bill prices in Bloomberg. You can see, just having a 3-month T-bill, you can get paid more yield than the 10-year treasury. The 10-year treasury, here's a chart of it, is currently 346. So this inverted yield curve to take, more risk with a longer dated bond, you have more sensitivity to interest rate changes and actually get paid less is just super highly unusual. So I hope this was educational for those of you screaming. I really appreciate you tuning in, and feel free to, if you have any questions that I didn't have a chance to answer, feel free to email us, and we're happy to take your questions. You can go to www.eyeball, like not eyeball, it's I like inflation, VOL like volatility, ETF.com. And there's a contact us page. So feel free to reach out if I didn't get to anyone's questions, and really thank the Money Show for the opportunity to have me on today. And hopefully this was a little bit educational for a couple people. So thank you so much.
All right, everyone, that concludes our time for this session. Thank you all again for joining us, and thank you, Nancy, for your presentation. Please be sure to stay tuned as we have a lot more in store for you today and the next couple of days as well. Thank you.